Hello, and welcome back to Legend Finance, your reliable source for all things finance. If you're new here, we're thrilled to have you. Today, we're stepping into the exciting world of options trading with a comprehensive tutorial, our 101 guide designed especially for beginners. Whether you're a novice investor looking to diversify your portfolio or simply curious about how options work, you're in the right place. We're about to demystify this financial instrument and help you understand how you can potentially leverage it to your advantage. Before we dive in, though, if you find our content valuable and you'd like to stay updated with the latest finance tips, tricks, and trends, make sure to hit that like button and subscribe to our channel. And don't forget to ring that bell icon so you never miss an upload from us. It's completely free, and it goes a long way towards supporting our channel. All right, without further ado, let's dive into the intricate yet exciting realm of options trading. Strap in because this journey is going to be fruitful. Derivatives. Derivatives are basically investments that get their value from another asset or rate. Picture them as a friendly wager between two investors, guessing which way an investment will go. Just like in any bet, depending on the outcome, one investor will end up paying the other. Options are a type of derivative that functions much like an agreement between two investors. Here's the gist. One investor sells an option to another. The buyer pays a fee or premium to the seller. This fee grants the buyer the right, but not the obligation, to buy or sell a specific asset at an agreed-upon price anytime before a set future date. In simple terms, the seller guarantees the buyer that they can buy or sell a specific asset at a set price while the option is active. Now, if the buyer has a call option, they can purchase a share. It's like betting that the stock price will rise. A put option, on the other hand, lets them sell a share, betting the price will drop. The profit hinges on the agreed price, strike price, and the market price when the option expires. Think of it this way: if a stock's price shoots up to $50 and you have a call option with a strike price of $40, you pocket $10 by exercising your right to buy the stock at $40. Sure, it's a straightforward concept, but keep in mind that options can have unique timing rules. For instance, with American options, you can buy or sell them at any time before they expire. But with European options, you can only trade on the expiration date itself. Now, you might be wondering, how does this differ from simply buying or shorting a stock? You might wonder, if you're expecting a stock price to rise, why not buy the actual stock instead of an option? The trick is that options offer a distinct risk-reward balance compared to directly owning stock. Picture the returns. Let's say you plan to buy a share from Plain Bagel Corporation. It's pretty straightforward. For every dollar increase in the stock's price, you make $1. If the stock price stays the same, say at $30, you don't make anything, but you don't lose anything either. All right, now imagine you've got a call option for a share of Plain Bagel Corporation. The premium is $2, the strike price is $30, and it expires in 3 months. If we map out the returns, it gets interesting. There's potential to make money, like with owning a share, but the $2 premium puts you slightly behind at first. The real magic happens when the stock price jumps above your strike price. This is when your call option is in the money. In this zone, you can buy the stock at a lower price, the strike price, and hypothetically, sell it at the higher market price. Let's consider the risk. When the stock price dips below your strike price, meaning the call option is out of the money, the most you can lose is the premium you paid for the call. Why? You can simply let the option expire if exercising it isn't beneficial. A put option works similarly, but in reverse. If the stock price falls below the strike price, you could buy a share at the lower market price and exercise the put to sell at the higher strike price, again limiting your loss to the $2 premium. So options can be seen as a form of insurance. They limit potential losses while still giving you a shot at profit if the stock moves as expected. Neat, right? But this is just a basic overview. While options can help you manage risk, they can also amp up your risk if you're feeling bold. Remember, options can be bought or sold. That's right, you can be on the other side, writing put and call options. Why would you do that? If you think a stock's price will stay steady or move a certain way, you can sell an option you expect won't be exercised, pocketing the premium right away. If the option goes unexercised, you'll score a tidy return. Wondering how it looks on a graph? It's like flipping the put and call option graphs. There's a catch when selling options. While your potential profit is capped, your possible loss can be substantial. It's crucial to note that writing options exposes you to more risk than buying them, especially when selling call options. Technically, you could lose an unlimited amount of money because a stock's price could rise indefinitely. So if you sell a call and the stock price skyrockets, you'll be stuck buying at that high price and selling at the lower strike price to the option holder. What if you sell a call option but also buy a share upfront to dodge future high market prices? This strategy is called a covered call. Voila! You've just stepped into a new realm of options. When you start mixing different security positions with their puts and calls, you unlock a world of potential strategies. Combining puts, calls, and underlying shares can significantly change your return profile. These combinations are regularly used in the investing world and have been given names based on their return patterns. Feeling positive about a position? Why not leverage that with a bull spread? If you're more pessimistic about a stock's future, a bear spread could help you profit from a price drop. Feeling inventive? Try the butterfly spread, which profits if a stock's price stays stable. And if none of these are your style, there's the box spread, which is basically a flat line. Options truly open up a world of possibilities. But before diving headfirst into endlessly tweaking your portfolio, there are some crucial points to understand. While stock options have many benefits, similar to insurance, they also have drawbacks. With insurance like auto, health, or life, you're only covered as long as you keep paying the premiums. If you stop, you lose the coverage. Plus, the higher your risk, be it of having a car accident, getting sick, or dying, the higher the premium you have to pay. Options work the same way. They're temporary with an expiration date, and the premium you pay only secures your position for a set time. So if you want to extend a protective put, you'll have to keep buying new options to maintain the hedge and pay the premiums each time. Secondly, various factors affect how much an option sells for. Generally, the more valuable the option to exercise is, the more expensive it will be. If you find a call option with a strike price below the current market price, for instance, you can bet the premium you pay will eat into any profits from immediately exercising the option. There's no free lunch with options. The risk-return dynamics are far more complex than simply buying a share. They're not suitable for those with only a basic understanding of how they work. But if you're comfortable with the concept of buying and selling options, how do you go about it? Just like stocks, options can be bought and sold via exchanges such as the Chicago Board Options Exchange, CBOE, or CBOE Global Markets. These exchanges are accessible through brokerages, but you'll need to check if your broker lets you trade derivatives. Options are also like bonds in the sense that you can sell them before they expire if you want to get out of the position early. And if you want to cash out without trading the underlying share, you can do so with an offset trade. Here, you take the opposite position in an identical call or put security, which effectively cancels out the two positions. Options are an interesting way to tweak risk exposure, but let's be clear, there's no quick cash to be made. It's a complex field that demands careful consideration. If you're new to investing, it's better to start with simpler securities before diving into derivatives. That being said, if you invest time in understanding options and the associated risks, as we've discussed, you can do some pretty cool stuff. Thank you so much for watching Legend Finance. Don't forget to like and subscribe to continue your financial growth journey with us. Stay legendary.